Hi, sir. We are Group 5. I'm Joey, and my group mates are Qingxian, Jolin, Huishan, and Wanjian. Our group's decision is to invest in Padini's holding according to its overall financial performance analysis, and we'll be explaining why. To start, I will compare the profitability between Padini Holdings and Cheetah Holdings and explain why Padini is the stronger investment. So from this table, we can see that Padini's GPM decreased from 39% to 36%, while Cheetah Holdings GPM decreased from 33% in 2021 to 31% in 2024. However, for the overall trend, Padini's GPM has been consistently higher than Cheetah Holdings. The reason for this is Padini have the ability to manage external cost pressures and it has a larger operational scale. Both companies also faced external factors like the cotton prices increasing by over 30% between 2021 and 2022, directly impacting their raw material costs. Besides, Malaysia's minimum wage also increased from 1,200 to 1,500 in May 2022, according to Ministry of Human Resources Malaysia. However, Padini managed this cost increase more effectively through economies of scale, achieving a gross profit of 695 million in 2024, as opposed to Cheetah only with 40 million. So, from their Padini's management discussion analysis, we also see that even though its sale mix shifted toward low margin products like basics and discounted stock, its diversified portfolio, including premium items, helped balance the impacts. In contrast, Cheetah's narrower focus on mid-range fashion limited its ability to offset declining margins. So moving on, while both companies increase promotions to attract customers, we can see that from their gross profit margins, Padini's scale allowed it to run these campaigns without severely impacting profitability. On the other hand, Cheetah invested heavily in rebranding and promotional efforts, including digital advertising, influencer partnerships. These activities largely increased Cheetah's selling and distribution expenses, further decreasing their gross profit margin, according to Cheetah's annual report. So, to sum up everything, Padini's consistent performance in maintaining higher gross profit margins despite external and internal challenges makes it a stronger choice for investment based on profitability.
Thank you, Joey. I'll now be explaining the liquidity of both companies. From 2020 to 2024, Padini's current ratio increased from 4.01 to 1 times to 4.38 to 1 times, meaning that the company is managing their working capital more effectively, highlighting its strong liquidity position. The company's consistent current ratio above 3.5 far exceeds the typical industry standards for fashion retailers, which is generally between 1.5 to 2.0. This indicates that Padini is not only capable of covering its short-term obligation, but also has substantial excess liquidity, which can provide a buffer against unforeseen financial pressures or be invested into the business for growth. In contrast, in 2020, Cheetah's holding current ratio was exceptionally high at 21.05 to 1 and peaked at 28.87 to 1 in 2021. This unusually high ratio suggested that Cheetah was holding excessive cash or inventory, potentially signaling inefficiency in managing its assets. Their current ratio dropped significantly in 2022 and continued to decline afterwards. The reason for the decline is due to a change of the company's operational strategy, redirecting their resources into other investments, leading to a decrease in current assets. External factors include increased supplier prices, forcing the company to adjust its cash flow and working capital structure. In conclusion, Padini's current ratio remained relatively stable and moderate, with only slight changes throughout the same period. On the other hand, while Cheetah maintained liquidity well above industry standards, its trend has large fluctuation and sharp declines. This is the calculation for liquidity and the chart. Thank you.
And now, I would like to share the comparison of inventories turnover performance between Pardini's Holdings and Cheetah Holdings. From the data in the chart, Pardini has maintained a strong inventories turnover which is considered healthy in the fashion retail industry. The internal factors that help Pardini to success are use modern digital inventories management system, update its product line every 3 to 4 months and build a strong brand presence. On the other side, Pardini reacted quickly to the post-pandemic recovery by launching promotion and adjusting inventories to match the new demand. Although turnover days slightly increased in 2023 and 2024, but they are likely due to rising inflation and more frequent replenishments as global supply chains stabilize. In contrast, Cheetah Holdings struggled with inventory turnover. Cheetah relies on an outdated inventory system using bulk purchasing strategies focused on basic clothing style and limited brand awareness further weakens its competitive edge. Externally, Cheetah faced strong competition and hacks the market resources to keep up. The company also overstocked during supply shortage, but demand fell short. In conclusion, Pardini's strong performance highlights the importance of advanced inventory system, brand development, and quick market response. And now let's all see about the data. We can see that the average inventory of Pardini Holdings is more than Cheetah Holdings. This means that the Pardini's holding can maintain more inventories and sell them out. And from the data of inventories turnovers, we can see that Pardini is more efficiency than the Cheetah Holdings. We can see that the Pardini can sell their inventories in shorter stay. And now we see about the charts. For this chart, we can see about the Pardini's holding takes the lesser days than the Cheetah's. So it means the Pardini's holding is more efficiency to Cheetah's holdings.
Hi, I'm Huishan. Now, I will be presenting a comparison of the leverage strategy between Pardini Holdings, Cheetah Holdings from 2020 to 2024, highlighting how both internal management and external market conditions shape financial decisions. Let's begin with Pardini Holdings. Over the 5-year period, Pardini maintained a relatively stable leverage ratio ranging between 0.37 to 1 and 0.45 to 1, with an average of around 0.4 to 1. This consistency indicates that the company takes a strategic approach to debt management, not avoiding debt by using it wisely to support business expansion while keeping financial risk in check. Notably, in 2021, there was a significant drop to 0.37 to 1, suggesting either improved internal cash flow or intentional debt repayment. This aligns with Pardini's internal strengths, namely disciplined capital allocation and strong financial planning by its finance team. Their approach allows them to grow their assets base through reinvestment of earnings and still use moderate debt when needed, all without overexposing themselves to risks. Externally, factors like the post-pandemic retail recovery and a low interest rate environment make borrowing more affordable, further supporting Pardini's balanced leverage strategy. Next, let's look at Cheetah Holdings. Their leverage ratio was very low, starting at 0.05 to 1 in 2020, declining to 0.035 to 1 in 2021, then gradually increasing to 0.1 to 1 in 2023, before slightly dropping again in 2024. This trend reflects a highly conservative financial approach, prioritizing self-financing, minimizing debt rather than using leverage to fund aggressive growth. Internally, this strategy may be influenced by Cheetah's smaller scale, slower business expansion, and a management team that prefers to avoid the risk associated with borrowing, especially during uncertain times like the pandemic. Externally, Cheetah faced strong competition and possibly limited access to credit, both of which may discourage borrowing. Additionally, inflation and rising borrowing costs could have made debt financing less attractive. So, from the analysis, we can know that Pardini's use of moderate leverage reflects confidence in its operations, steady cash flow, growth ambitions. This allows the company to scale more effectively and remain competitive. Contrast, Cheetah's minimal leverage suggests a risk-averse strategy, which might protect them during downturns, but also limits their ability to expand or compete with larger players. In conclusion, Pardini Holdings demonstrate a balanced use of leverage, supported by careful debt management, stable financial performance, and a strong market position. This makes Pardini an ideal target for success financial analyst Berhad's finance director, especially for investors seeking moderate risk, long-term returns with an emphasis on financial sustainability and growth. That's all from me. Thank you.
Hi, my name is Ma Wanjian, and for my part, I will talk about the shareholders' investment ratios. We use the price earning per share to measure a company's profitability, which indicates how much profit each outstanding share of common stock has earned. The higher the ratio, the better the financial performance. So let's start with Pardini Holdings. Pardini's EPS is low in 2020 because of COVID-19. The retail store were shut down and people were not spending their money. In 2021, it became more worse. The consumer confidence was still low. They also faced higher fixed costs, which slowed the inventory turnover. But from year 2022, the economy reopened. The Pardini improved their cost control. EPS jumped to 23.42 cents, and then in 2023, it even went even higher to 33.85 cents. The company grew revenue by strong sales and good pricing strategies. Pardini faced some global economic uncertainties in 2024. Their revenue was actually higher than the year before, but costs rise too. So the EPS dropped slightly to 22.28 cents. In contrast, we have Cheetah Holdings struggle with weak profitability. Its EPS was negative for the most of the years. Cheetah has a low EPS in year 2020 because its poor sales, poor cost control, and didn't really have a strong e-commerce presence. Cheetah actually made a profit in the next year. EPS turned positive to about 1.95 cents, mostly because they cut a lot of costs, so the net income has improved. But in 2022, EPS dropped back to negative. In 2023, it even dropped to negative 3.77 cents because Cheetah had write off about 1.9 million ringgit in receivables. Also, they issued more shares, which made the EPS even lower. The good news is in 2024, Cheetah's EPS turned slightly positive at 0.38 cents, helped by recovery of previously impaired receivables. And here is the calculation for EPS. And this is the graph for us to visualize the change of EPS. So we can see that while both companies face external challenges like the pandemic and competition of market, Pardini was much better at managing costs and operation to keep a steady profit. And in conclusion, Pardini Holding is a good investment choice for anyone who looking for a return growth over the medium to long term in Malaysia. It has a strong record of making profits and running its business well, which shows it can handle most of the challenges and control risk. Pardini's strong financial position means it can grow without taking on unnecessary debt, and its focus on sustainability and branding helps it stay ahead in the retail and fashion market. For investors, it means Pardini is not only stable now, but also has a good potential to give stable returns in the future. And that's the end. Thank you.